Imagine a DeFi protocol so ambitious that it aims to merge spot trading, perpetuals, lending, options, insurance, and stablecoins into a single unified on-chain balance sheet, one where every dollar you deposit works across the entire ecosystem at once. That's not science fiction. That's Flying Tulip, the latest and boldest project from Andre Cronje, the architect behind Yearn Finance and Solidly. Welcome to the Block Analyst. If you're serious about understanding one of the most anticipated DeFi projects of this decade, you're in the right place. Don't forget to subscribe. Today's episode is long, detailed, and essential for anyone considering the upcoming Flying Tulip public sale. Flying Tulip is one of the most hyped DeFi innovations currently in development, a full-stack on-chain exchange that unifies all major financial primitives into one cross-margin system. Founded by Andre Cronje, this protocol represents an evolution beyond the fragmented DeFi model into a cohesive, self-sustaining, and fully composable on-chain economy. Let's unpack this step by step, from the technical architecture to tokenomics, from investor protection mechanisms to the long-term vision. We'll also cover why institutions are flooding into this project and what risks remain. At its core, Flying Tulip is designed as a holistic on-chain balance sheet. It merges spot trading, perpetual futures, lending, options, insurance, and a yield-bearing stablecoin called ftUSD, all inside a unified margin system. Every deposited dollar of capital is simultaneously productive. The same USDC can earn yield through lending, serve as margin for perps, underwrite insurance risk, and provide AMM liquidity, all without duplication. The result is a new capital architecture, one that mirrors the efficiency of centralized exchanges but operates with full transparency and self-custody. In September 2025, Flying Tulip raised $200 million at a $1 billion fully diluted valuation. The protocol now plans an additional $800 million public sale, bringing the total to $1 billion raised at the same 10-cent token price. This sale will be distributed across $200 million on Impossible Finance, $200 million on CoinList, plus allocations for supporter and intent whitelists. What makes this round revolutionary is its built-in perpetual put option, the first on-chain redemption right in crypto fundraising. It allows investors to redeem their principal at any time, protecting downside risk. Let's dissect how this model works. When you invest, you deposit ETH, USDC, USDT, USDS, USDE, SOL, or AVAX. In return, you receive FT tokens at 10 cents each, along with a perpetual put option embedded in an NFT. All raised funds are locked into segregated on-chain reserves. These cannot be used for operations, ensuring full transparency and solvency. From there, investors have three options: hold, keep both FT tokens and redemption rights indefinitely; redeem, burn FT tokens and reclaim your initial investment. 1 ETH in equals 1 ETH out. Withdraw, sell your FT tokens but lose redemption rights permanently. Reserve assets are deployed into low-risk yield protocols like Aave, Ethena, and Spark, targeting roughly 4% APY, around $40 million annually on a $1 billion pool. That yield covers expenses, token buybacks, and incentive programs. Every redemption is handled on-chain by audited contracts with a queue mechanism to handle temporary liquidity constraints. This structure turns token ownership into a two-sided contract. Investors retain verifiable control over their capital until the protocol demonstrates consistent productivity. Flying Tulip's tokenomics break every convention. There is no team or founder allocation. The team earns only through open market buybacks. 40% of protocol revenue is used to buy FT tokens on the open market. Revenue allocation post-launch is as follows: 40% to team buybacks, 20% to foundation, 20% to ecosystem incentives, and 20% to reserves. This aligns incentives directly with performance. No pre-mint, no emissions, no hidden vesting schedules, only continuous buyback-based compensation. Flying Tulip introduces ftUSD,
a soft-pegged $1 stablecoin offering 8 to 12% APY through delta-neutral DeFi strategies. Unlike USDT or USDC, ftUSD is fully on-chain, backed by yield sources like Aave, Compound, and Morpho lending markets, staking derivatives, LSTs and LRTs, AMM liquidity provision, and perpetual funding rate arbitrage. This multi-strategy design maintains stability and yield without off-chain dependencies. ftUSD is also composable. It can be used for trading, collateral, and lending inside Flying Tulip. Compared to Athena's USDE, ftUSD is more diversified and transparent, sacrificing slightly higher returns for greater sustainability and full on-chain verifiability. Most DeFi perps rely on external oracles like LinkChain. These bring latency, centralization, and manipulation risks. Flying Tulip eliminates this dependency. Its FT perps derive prices directly from executed trades, not oracle feeds. It combines AMM for depth and liquidity, CLOB for precision and efficiency. The result is near real-time price discovery, settlements under 500 milliseconds faster than any DeFi competitor. However, this system depends on deep liquidity. Until TVL exceeds 100 million, whales could theoretically manipulate prices internally. Flying Tulip employs safeguards like leverage caps, liquidation limits, and circuit breakers, but the risk of strategic manipulation remains until deep market maturity. Flying Tulip's architecture is modular. FT Spot, a hybrid CLOB AMM exchange launching on Sonic Network with zero-fee trading. FT Perps, Oracle-free perpetual futures with up to 100x leverage. FT Lend, unified lending with cross-margin integration backed by ftUSD. FT Options, on-chain options suite for hedging and structured products. FT Insurance, on-chain coverage pools for protocol and counterparty risks. Each component reinforces the others. Spot and perps drive liquidity, ftUSD and lending retain capital, while options and insurance enhance durability and capital efficiency. Flying Tulip's $200 million seed round attracted some of the biggest names in DeFi and traditional finance. Breven Howard Digital, Coin Fund, WF Labs, Falcon X, Hypersphere, Lemnis Cap, Nascent, Republic Digital, Selene Capital, Sigil Fund, Susquehanna Crypto, and Virtual Protocol. This investor mix spans macro hedge funds, liquidity providers, and DeFi native funds, signaling institutional confidence. However, WF Labs' participation introduces short-term speculation risks due to their trading behavior in prior launches. The $800 million public sale will roll out in 4 rounds. Supporter whitelist round. Invite only, limited caps per address. Intent whitelist round. Open registration, allocation based on submission timing. Public rounds. On CoinList and Impossible Finance. Open, first-come, first-serve access. Impossible Finance was chosen for its multi-chain issuance support and fair launch design, aligning with Flying Tulip's investor protection ethos. Andre Cronje's reputation precedes him, founder of Yearn, Keeper 3, Solidly, and contributor to Phantom, now Sonic Labs. He's known for brilliance and volatility, rapid innovation followed by abrupt departures. Flying Tulip marks a shift. It's his first architecture designed for long-term solvency, integrating his previous experiments into a unified, self-sustaining protocol. There are 3 possible trajectories. Bull case, the Binance of DeFi, 25%, $5 billion plus TVL, ftUSD top 5 stablecoin, FT token 10x to $1, annual revenue $200 million plus. Base case, mid-tier protocol, 50%, $500 million to $1 billion TVL. FT token doubles or triples, sustainable but not dominant adoption. Bear case, redemption spiral, 25%, under $100 million TVL. Redemption pressure drains reserves, FT token declines 50 to 80%, Cronje exit risk or exploit event triggers sell-off. Flying Tulip is an ambitious attempt to institutionalize DeFi, merging the best of Yearn's yield routing, Aave's capital efficiency, and GMX's on-chain derivatives into one system. It's a new type of financial OS, composable, transparent, and capital efficient. If executed correctly, it could become the first fully decentralized cross-chain equivalent of Binance. If execution fails, it could be another cautionary tale in DeFi's experimental history. For DeFi veterans, calculated exposure, 5 to 20%, may make sense. For risk-averse investors, observing the post-launch behavior is prudent. Flying Tulip isn't just a protocol, it's a test for whether DeFi can finally operate at institutional scale. Thank you for watching The Block Analyst. This video is for educational purposes only and does not constitute financial advice. Always do your own research before investing.